Bismillahirrahmanirrahim. Welcome to this Ignite Digital panel called The Good Side of Money, where we are going to explore the ethical dimensions of investing. We have with us two extraordinary panelists who are going to help us on this journey. We have Rahana Nathu, who is the founder and CEO of Spectrum Impact, a strategy consultancy that supports a range of organizations looking to expand their impact investing footprint. And we have Danish Admeri, who is the head of crypto at Wealthsimple, which is a new fintech platform focused on providing financial services for Canadians. My name is Latif Noorani. I am an alwais, that is an educator within the Ismaili Jamaat, where I spend a lot of time thinking about the value system of Islam and Maulana Haj Imam, the Aga Khan's guidance on our interpretation of that value system and how we can live that value system in our day-to-day lives, in our business lives, in our professional lives, and in our investing lives. So I am very much looking forward to hearing from our panelists on how we can find the good side of money. Let's start, Rahana, with you. Can you tell us a little bit about what is impact investing and what does your firm do?
I'm happy to. Thank you, Latif, and thanks, Ignite, for having me. So as Latif shared, I run an impact investing consulting firm called Spectrum Impact. And essentially, we help investors, primarily allocators, figure out how to build programs, products, and strategies in this crazy world that we call impact. So we define that body of work specifically as investments that are made into products, funds, or companies with the intention of both generating financial returns commensurate with whatever financial expectations are and generating positive, intentional, explicit social impact. And so the world that I come from really tries to equalize both the financial and the social positive outcomes that you can have from investment activity and turns a relatively values agnostic way of thinking about deploying capital into a very front of mind exercise. So every single investment has impact. The world of impact investing is just about making that positive, explicit, intentional, and outcomes oriented.
Cool. And Danish, tell us, what is cryptocurrency and what do you do at Wealthsimple in that space?
Yeah, sure. So, like Rana said, thanks for having me here as well. And yeah, I think crypto, I'm sure a lot of people have heard about it in the last few weeks and months, is a new form of a currency and a technology that is really transforming not only financial services, but all sorts of digital ecosystems. And, we're very much in the early innings of what that's going to look like. But I think like many technologies that have come before it, it has the potential to be really transformational for many industries. And for me in particular, my focus is on thinking about how crypto fits into the broader business at Wealthsimple. And Wealthsimple is a Canadian fintech platform, which is really reimagining the way banking should be delivered to individual customers. And so, we have many different product lines across investing, everyday banking, and savings. And crypto is one of our newest additions to that business. And we're really thinking about how do we make access to this new asset and this new ecosystem more accessible and more understandable to the average person. And that's really my focus on a day-to-day basis right now.
Great. Well, I'm really looking forward to making crypto understandable. Rahana, I'm curious about this idea of impact investing. Can you give us an example of what an impact investment is or how you might help a client find an impact investment?
Yeah, of course. So I think one of the biggest misconceptions around impact is that they're rare and it's hard to find really viable deals. I think what we've learned from the last 10 years of this industry just sort of exploding is that most investments are impact. It's really just about your frame of mind and your intention when you're about to go into these transactions. So my favorite example in the whole world is Husk Power Systems out in India. So this is a biodiesel generation power system that uses a very old-fashioned crank to actually generate power that's far safer and more ubiquitous than currently what is required and the lack of infrastructure to support it. The outcome of these quite literally machines, I mean, this, if crypto is like the technological avant-garde, and crank energy is on the other end of the spectrum, no pun intended. So we're really talking about zero technological invention, but using a surplus of human labor and interest to actually generate power. The byproduct of this actual power generation is a material that can be used in candle wax, soap, stuff like that. And so Husk created local energy supply by using a very old technology. The byproduct of that technology actually allowed women's groups, mostly co-ops, to create candles and soap and to sell them in markets. And so I love that example because it's a very simple innovation. It doesn't actually require technological prowess, but it's a demonstration of when you use investment capital to actually provide core social services to people, you often actually have multiple types of value that are generated, and all of those values can be counted morally, but more specifically, they can be counted financially. So the amount of savings that is now in that family's pocket, the amount of income generation, the amount of power generation, the extended day of the homework cycle, the extended day of the cooking and bathing cycle. And so it's, again, very simple example, but any types of investments that are trying to deliver social services at scale often actually have a financial opportunity in them. It's just our hard work to figure out who, what, where, when, why.
Okay, so if I wanted to invest in Husk, right?
Yeah.
What kind, and not maybe not the specific company, but like, would I expect the same kind of returns I would make if I was going to invest in, say, Nextera Energy in the States, or PowerX in BC?
It's an important question. So I think, Latif, what you're getting at is critical, and that is this myth in the impact investing industry since it began that in order to deliver true impact, you have to be willing to take financial concessions. And I think what we've learned from the impact investing work is that in traditional investing, trade-offs are absolutely necessary, right? They dictate what asset classes you go into, how much money you put into things, where you put things, what countries you put things. So trade-offs are an inherent part of the traditional financial ecosystem. The same is true for impact. So in impact, once again, you are engaging in trade-offs, but the types of trade-offs that you're making are different than a traditional transaction. And so I would say that we have, and this is not just me, we have plenty of data to prove that inherently, no, impact investing is not concessionary. Just because you want to invest in your values doesn't necessarily mean that you're going to lose all your capital or give up some sort of return. But like you would in traditional investing, there are trade-offs that are necessary as you're considering that particular investment. So a great example is fossil fuels. So when COVID hit, anybody who had a large exposure in fossil fuels had a really rough 8 to 10 months, particularly as consumption went down and production went down. That is pretty in line with an entire concept in impact around environmental dependency, and the idea that being so reliant in your portfolio on any kind of finite resource is probably too risky to actually make sense for a portfolio, period, full stop, whether you're motivated by climate change or not. So if you divested of those positions during COVID, you did pretty well. In the last 2 months, if you were holding fossil fuels, you also did really well. And that's just the cyclicality of the market, right? So I think that's just such a beautiful recent example of how in each stage of your decisions, trade-offs will happen. But is a financial trade-off required to invest with your values? Not necessarily.
But tell me, so if I think about investing in a small company in India, right? To me, when I think about investing, I think about, look, risk, reward, right? And the higher the risk, the greater the return I expect. And it sounds like what you're telling me is that when you think about impact investing, you think about more factors than just risk and return. You're thinking about other things as well.
Yeah. So what is, I think that point is so well taken, Latif. What is complicating about impact investing is instead of a truly dual relationship, right? More risk, less return, more return, less risk, more return, wherever you land on that sort of teeter-totter. In impact investing, you have a third dimension of impact, and impact moves commensurate with risk. So what's interesting is that even though it's three variables, risk and impact move in a linear sort of relationship. And so as you increase your tolerance for risk, you are also creating outsized opportunity for impact. And intuitively that makes sense, right? Because the things that need so much of our time and energy are often untested and do not have market-based solutions. And so going into investments in these particular sectors are risky because they are new and untested. And so because of that, your return potential should be outsized, which is why you often see impact investing in the private markets, mostly venture capital and private equity. I think that helps some investors sort of wrap their heads around, oh, okay, so I'm really just talking about another dimension of risk, which is outsized impact. That narrative doesn't work for everybody, but it does work for some. I think what we are finding in the broader conversation around impact investing is that the way that we evaluate success around social metrics is as hard now as it was 75 years ago when development finance started. Impact investing hasn't solved for the difficulty of trying to put a quantitative value on someone's qualitative quality of life. That still continues to be a problem. And I think that that's actually what makes this work so challenging. So, the common metrics that we look at often around health, education, wealth, savings, access to clean services. Those are still very typical ways that we measure whether an investment had some sort of outsized impact. But I would say that on the measurement and evaluation side of things, we're still figuring it out. The beauty of finance is that it is very easy to understand if it works or not. The complexity of impact investing is not quite. It is a very long-term problem with a very short-term tool. So I think we're still navigating in real time ways to develop much better evaluation systems to really find out if one transaction actually impacted, gender equality in 15, 20, 25 years.
And so that is I guess, a long-term view of investing, right? That,
Yeah.
You invest in Exxon today, or, you invest in Exxon 10 years ago, now you're going to suffer today, and you want to make sure you're diversifying all the kinds of risk, right?
Right.
But, and what you're saying is that's not in conflict with this idea of profit maximization. Though I will say, we have this traditional idea, right? So if you look back at like Milton Friedman, right, who sort of articulates
Right.
The classic articulation of the corporate social responsibility is to profit, right?
Right.
That is the responsibility of the corporation, is to make money.
Yeah.
And then he says, well, then if you make lots of money and you want to do good with it, then go and give it to charity, right? And so that's the Rockefellers and the Carnegies, the robber barons of the past, right? Made money doing terrible things, monopolizing. And you look at the Sacklers, right? Lots of rich families build businesses with, with hindsight, questionable tactics, but then go on to can make huge contributions, right? And it doesn't really matter how you make it, and whether you care about the environment or gender equality or any of these other things you talked about, right? Just forget about them, because they, in the short run at least, they will hinder profit a little bit. So let's not worry about that. Let's just worry about quarterly profits. Let's maximize those quarterly profits. We'll make that money, and then we'll go do good with that money we made. What's wrong with that, as opposed to what you're describing as kind of integrating some of that impact into your initial investment?
Yeah, I think that philanthropic approach is going to be right for a lot of people, particularly in the United States, where there's all kinds of tax benefits to large charitable contributions. And that is still an important tool that I think we're going to continue to sort of have and see. Interestingly, I think the way that I might answer that is kind of from the other way, which is when a grant is made, that's 100% loss of capital the minute that it goes out the door. That's not to say that it doesn't generate 10, 20, 30x impact, but not a cent of that capital is coming back. And for endowed foundations like Rockefeller, per your example, that's perfectly fine. That's within the mandate. That said, if these problems were easy to monetize, none of us would be here. And so I'm glad that you brought this up, because I continue to feel very strongly, especially having spent so much time in the philanthropic sector, we're going to need foundation solutions to a lot of those problems. And foundation level capacity building, creating local markets, building the field, demonstration effect, blended finance, all of those things signal to the private investment community that there's an opportunity there. And where there is not, foundation capital actually levels the playing field so that the capital markets can come in. It's going to continue. I actually think it's been a really beautiful partnership between philanthropy and impact investing. And I sincerely hope that continues impact investing is not a silver bullet. It's only really going to work where investments work.
All right. This reminds me of this idea of the enabling environment, right? One
Yeah.
Ajumam talks about the enabling environment is creating a place where people can then thrive, right? Creating places of opportunity. And there's a role, as you described, for foundations to create that place of opportunity where then capital can go and thrive. I think that's a very attractive idea. I want to turn the conversation to crypto. So, Danish, I will tell you as sort of a non-crypto person, when I first hear about Bitcoin, the first thing I think about is criminals and the deep web and people, using Bitcoin to anonymously buy drugs and guns. Is that what crypto is? Is that a misconception? How am I wrong about this?
Yeah, I think that was much more true several years ago when Bitcoin and crypto was very much in the early stages of its implementation. And I think, now the narrative has evolved so much further beyond that even the data that you can assess, on the blockchain, which is a public ledger that is visible to literally anyone, like you and I can go look up every transaction that happens on the Bitcoin blockchain today. And of all the analysis that's been done, it's been pretty clear that less than 0.5% of all transactions that happen are associated with any illicit activities. So I think a lot of this is a little bit of a sensationalization in the media and the narrative from something that is definitely an esoteric concept. So it's hard to understand. It's latched onto certain narratives over the last few years, and every time Bitcoin and crypto is in the headlines, there's one or two things that are relevant at that point in time that really take up the majority of the headlines, but it's hard for the mainstream sort of coverage around this type of industry to cover, the vast ecosystem of innovation that's happening. So, can Bitcoin be used for activities like that? Absolutely, but so does regular cash, and has been for decades now. So I think that's not something that's necessarily unique to Bitcoin. Money is just a mechanism for exchanging value, and in any technology or with any use case, there will be bad actors that will try to take advantage of that opportunity. And that's not new to crypto. It's not new to the regular financial system, and it's not really new to any technology. So it's not a false narrative necessarily, but I think one that's has been elevated much more beyond what the reality on the ground is, and I think unfortunately hides a lot of the great innovation that is happening that doesn't necessarily get as much attention.
That's fair. So another maybe myth about crypto, and you hear a lot about this in the New York Times, and this goes back to Rahana's ideas about fossil fuels, and people tell me crypto requires an enormous amount of energy to mine cryptocurrencies, and they're burning, Bitcoin burns 30 coal plants worth of energy every day. Is cryptocurrency bad for the environment? Is it not a green option?
Yeah, I think unfortunately there's no simple answer to a question like that, but I think it's important to maybe peel back a few layers to understand how the environment is a stakeholder in the crypto ecosystem. So there's Bitcoin, which is a proof of work blockchain, which essentially means these miners around the world are expending a lot of energy to try to cryptographically solve essentially like a very complex math problem to validate transactions on the Bitcoin blockchain. And it's that expenditure of energy in search of a reward in Bitcoin that creates the incentive for these miners to do that work. And that's what makes the entire Bitcoin blockchain operate. But then there's a whole class of other cryptocurrencies like Ethereum and others that have evolved from Bitcoin over the last decade that operate on a totally different consensus mechanism, which is called proof of stake. And Ethereum actually is still a proof of work blockchain, but is in the midst of transitioning to proof of stake. And for simplicity, that essentially just changes the entire mechanism where the energy expenditure of mining is no longer used at all in validating transactions. And so in that sense, there's a whole proliferation of crypto assets that don't have any of the environmental impacts that Bitcoin does. And so I think that's one nuance that's important to distinguish between crypto overall versus Bitcoin and the other blockchains.
So this brings us back to something Rahana was talking about, which is this idea that, look, every investment has impact, right? But that if we think about things in a longer term view, every investment has an impact on people and the environment. And we want to think about, when we're thinking about reducing risk in our portfolio, we want to think about those long-term risks. And so how does it sounds like that idea fits very well into what you were just talking about. I wonder if you could elaborate on this idea that we can, considering those climate impacts of Bitcoin and less maybe in some of the other currencies, how would we think about, if you were thinking about it from the way Rahana thinks about it, right? How would we minimize risk, long-term risk or environmental risk in shaping a portfolio around crypto?
Yeah, so I think, there's ways to do that, very directly through things like carbon offsets, for example. And I think this is an area that more and more people in the crypto ecosystem are adopting as a way to really put a specific price on the cost that Bitcoin has on the environment. And so, today I think it's challenging for the average person that's investing in Bitcoin, let's say, to understand what that impact is and then be able to offset that directly. But that's an area where platforms like Wealthsimple and Coinbase and others in the industry can really help make that bridge really easy to cross by doing that work on behalf of clients and really letting them opt in a very simple and easy to understand way. Very similar to how when you buy a ticket on an airlines, you're able to offset your specific impact on of using that flight through your point of transaction. And I think that is still in the early stages in the industry and not something that people are really thinking about. But that is, I think, one way that's going to have like a very real way for the average person to think about that particular risk.
Rahana, I'm curious. Could you weigh in on that? Do you have a view on it?
It's thanks for reading my mind, Latif, because I was chomping to say something, but did not want to interrupt this phenomenal flow. One of the things that I loved about what Danish was saying was around this idea of comparison other. So in the broader sustainability conversation, of which impact is a part of, we often have to remind ourselves to focus on not absolute impact outcomes, but material ones. So in the context of ESG, environmental, social, and governance indicators, what is material to one particular industry or business is not what is material to another. So Danish was making the example of the banking sector, right? So a Wealthsimple with minimal, if any, physical footprint still beats 150 branches per country, 183 countries any single day. And so it's so easy to think sometimes about climate energy expenditure in absolute terms. But I think one of the things we're getting smarter at is to have a more relative conversation, which is a material conversation. As it relates to our industry, what exactly is our impact on the planet? Given our impact on the planet relative to our industry, how are we mitigating some of that? And I think that that's a complicated conversation, which is why that's not the conversation we have sort of in the public forum, right? Because there are sort of levels to like, oh yeah, what is that materiality? How do we assess that? But I do think that some of these technologies do sometimes get a bad rep because we have a tendency to sort of simplify the whole conversation.
Thanks. So Danish, I want to go back to you because, and maybe you can help me understand because you talked about this idea of using the blockchain to capture and trace and add transparency to things like carbon offsets or maybe other things that Ron has been talking about, other social outcomes, right? And it sounds like to me the blockchain is a platform where you could do that, but that's distinct, I think, from cryptocurrencies. So could you help us understand the difference between the blockchain, which underlines some of these cryptocurrencies, and how that blockchain can be used to, as you described, sort of levelize and democratize important outcomes.
Yeah, for sure. I think a lot of people focus on cryptocurrencies as this new asset class and as a way to potentially make a big return, and it's generally like a very volatile asset class. But I think what's most interesting is the underlying technology that is the foundation for crypto, and that's what blockchain is, and it's essentially a database that is publicly available and is validated by a network of computers around the world. And so instead of having a single server or a single computer that is a source of truth, much like your bank today, instead a blockchain relies on thousands of computers around the world, all recording a version of every transaction, so that no single computer is responsible for being the source of truth. And it's the collection of all those computers that actually represents what is true, which provides a lot of interesting properties. And one of the most important ones is the fact that it's immutable, which means no single person can go back and change something. And that permanence is what gives trust in the underlying data that the blockchain represents. And so for something like Bitcoin, the fact that there's only ever going to be 21 million issued, and every single transaction that happens is provably verifiable, is completely uncensorable, and is immutable in terms of you can't go back and change the fact that someone sent one Bitcoin from X to Y. Those are the things that underpin Bitcoin's value proposition, and the fact that it's not controlled by any single entity is the thing that actually proliferates its use case, and as a way its use case as like a neutral money. And so if you strip away the Bitcoin piece of it, a lot of the underlying technology still could be used in a lot of different use cases. And that's where many of these other blockchains that have come up are really trying to figure out what that might look like. And Ethereum, I think, is the sort of leading example of what building this decentralized application layer on top of this blockchain technology could actually look like. And so, you could take any industry like social media or financial services or music and build that on top of blockchain technology, which would provide a lot of unique use cases that aren't possible today in this decentralized way. So, taking banking as an example, today you need to have a bank account, and you need to have this intermediary that is granting you access to your money, that's determining whether you can or can't get a mortgage, that's deciding whether you can and can't spend your money at a particular shop or restaurant. With a decentralized finance application, all of that will be possible entirely through code, and that code is what runs on top of the blockchain. And it's really just a set of rules on that dictate how the system should operate. And because now you have native value that can exist on the blockchain, you actually have the ability for money and value to interact with these different applications that mimic all the things that a bank does, but without needing a bank to exist in the first place. And then in a similar way, you could think about what does Instagram or Facebook that's built on the blockchain look like? And that creates really interesting models where the current problems that people have with Facebook is, it's extracting all of this data and using that data to sell these clicks to advertisers, and that's their entire business model. And we've seen all of the negative effects that's had. But what if you could build that on an open distributed ledger where the users of the platform actually own and control the platform, where there's creators that aren't dependent on a YouTube or an Instagram to gatekeep their ability to make money and sell products and services. And so all of that is very early and doesn't really exist today. But I think that is the direction where we're headed, where there'll be all kinds of applications that the concept of a decentralized distributed ledger plus an application layer that allows you to build modern day applications on that platform will enable in ways that a centralized setup today that we have with most of the things we use on a day-to-day basis just fundamentally can't make possible.
I think there's such an interesting ethical dimension to that, right? Because what we have seen historically is these gatekeepers, as you described them, the banks, the credit card companies, and these big tech companies, they, as gatekeepers, in reality, we have seen those gatekeepers gatekeep out many people who don't look like them. And it seems to me that this idea of democratization will give access, or at least theoretically could give access and levelize the playing field for people of all kinds of diversities, right? Of diversity of language and sexual orientation and gender and religion and skin color, like all of these things that have historically been structurally imposed against those who are most marginalized in the world, may be able to no longer rely on those gatekeepers and use this democratized platform that you describe. And yet you say it's still early days, right? And in these early days, do you see that happening? Or do you see those existing power structures just being replicated even on this democratized platform?
No, absolutely. I think, this is one of the things that I'm personally most excited about the space, even at the stage that it's at today. If you look at the applications and protocols and use cases that are being built across the, crypto and Web3 ecosystem, there are so many builders that span the globe. And there's people that I've directly interacted with from India and Africa and South America who, they are building incredible applications, and all they have is, a laptop and access to the internet and this open, permissionless ecosystem to build on. And the fact that there is no one deciding what they can build or who can access these technologies, it's given all kinds of amazing, like, creative expression and ways for people to build interesting applications that in any other context just fundamentally wouldn't be possible. And I think what makes crypto even more interesting, and I think this is like a very new and hard to sort of understand concept, but it's very real, is the fact that many of these things are built entirely by anonymous people. So these are, avatars on Twitter that are building these projects, and they're raising money from venture capitalists to the point where the VCs don't even know who they're giving money to, because all they've vetted is the code. They can see that it works, and all of this is done in an open and transparent way. So, in a way, the person that's behind the keyboard, it doesn't even matter what some of those characteristics that you mentioned are, because it doesn't even need to surface in order for you to be able to create value.
And so, Rahana, if I want to have impact, and I want to say, look, diversity and encouraging pluralism is like my investment thesis, right? Are these blockchain platforms something that I should be thinking about? How would I think about that when making that investment if pluralism were my investment thesis?
Yeah, I mean, so I think there is a subset of impact investing called gender lens investing, which basically crystallizes the idea of intention even further to consider the impact of products, goods, and services on women, girls, and non-binary people. So if you were a gender lens investor and you were looking at the broader field of crypto, and specifically Danish's point about how investment decisions are made based on non-defining attributable characteristics, that would check a ton of boxes, right? Because if you were making this point, part of what I think we're all contending with, whether you're in finance law or in financial services, is that systems coalesce around power, and the systems that have this power are so old they're not even quite relevant to our time anymore. And so unfortunately a system feeds off of itself, and that's how the power grows, and the power feeds the system, and we go on and on and on. And so I think part of what is wonderful about this kind of disruption is that we're not just looking at output, but we're also looking at the process of decision making. And so if you were an impact investor who really cared about diversity across all of the different definitions of that, the way that investment decisions are made is as fundamental as what you are investing in. And so investing in a particular type of service that does not care about those things would be great, because you're focused on output. There is also a subset of the work that we do around digital access, which is a whole separate ballgame, right? So, to Danish's point, you need the laptop and the internet to be able to be a part of this ecosystem. But barring those things, which are not insignificant in some parts of the world, but barring those things, you too can be a part of that community. That's a separate kind of inclusion that I think impact investors are quite keen to find and replicate over and over and over.
Thank you. We're about to wrap up, but I want to pick up on one thing you said to change topics a little bit. But you talked about how you invest is as important in these contexts as the investment, the process. And it seems to me that's also true of our careers. And I think we have some younger viewers here who are thinking about how to invest in their careers. Where do I spend my time and use my talent to grow in a way that is good? And so could you, Hannah, tell us a little bit about your career path and how you got to where you were and some of the decisions you made along the way that have led you to having a good career?
I'm happy to. So I born and raised in Toronto, thought I wanted to be a lawyer for pretty much forever, and had a chance in undergrad to test that out, and found that it wasn't a great fit for me, and was a little bit sort of lost in what to do with all of that. And had an opportunity while I was at school. I went to Queens. Had an opportunity while I was at Queens to abscond to Bolivia for about 6 months to work for a renewable energy NGO. And I think, Leth, you and I have talked about this, but it's so cliche, but those experiences truly are life-changing because they just create a different sort of dimension to view the world. And it's kind of the kick that I needed to pivot a little bit. So I went to grad school here in the United States, which is where I live now, focused specifically on foreign policy and development finance, and got my start at the UN, at the UN Capital Development Fund, which is the private lending arm of the United Nations Development Program. So it's the closest thing within the UN system that comes to a investment making, revenue generating body. And had the good fortune of working on project finance transactions in energy and agriculture in Uganda and Tanzania. And that was the moment for me where I realized that the direct impact on the ground, deal to deal, is phenomenal. I'd never experienced that in my life, didn't know if that would actually happen again. But the questions that were keeping me up at night were the systems oriented ones. Why does the UN need to come into DAR to connect local farmer with local bank? Why isn't that happening naturally? What's broken in the system that conversation isn't happening automatically? What about the way that we assign and value credit is broken? And so these systems level questions sort of took me to impact investing. So I went over to the Rockefeller Foundation and worked in their impact investing program for a little while. And then went over to the traditional banking sector, spent some time at Bank of New York Mellon building their first impact fund of funds, and then finally in-house at the Case Foundation, the AOL co-founders, doing impact work for their family. And I think across all of these roles, I had very similar jobs. They were always strategy oriented. They always had a product and or structuring angle to them. They were similar in the way that the titling worked and all of that stuff, but they were drastically different organizations. In my mind, maybe naively, a Rockefeller and a Bank of New York Mellon should have had nothing in common. Their assets were different, size was different, motivation was different. And yet every single one of these organizations faced very similar barriers to making impact investing programs long-term. It was very easy to build the plan. It was very hard to keep at the plan 3, 5, 7, 10 years later. Which is why I started the firm, to try and solve the staying power problem. When I was coming out of school, impact investing was only really available to people that were graduating from business school. It was not a multidisciplinary approach, of which I was not one of those people. I went the international development route. I would say for folks that are really passionate about impact investing today, first, it's nearly ubiquitous, which is a crazy thing to say out loud because it's only been 12 years and I don't quite know how that happened. But second, I think finally we figured out a way to use multidisciplinary training to solve multidisciplinary problems. So regardless of your background, there is a very critical role for your worldview to be a part of the impact investing conversation. And so if you don't have financial skills, maybe a transaction level job is not for you, but there is absolutely a role for you in the space. And that is that's a lovely evolution to have come to in such a short period of time. So I'm very happy about that.
Thanks, Rohanna. Danish, what about you? Can you tell us a little bit about your career path and some of the ethical questions you face at some of the pivot points?
Yeah, for sure. So, I, like probably most people in this room, had a pretty standard, high school and university experience. I knew I didn't want to do science or medicine, so decided to study business instead. And from that, went to a management consulting firm called Boston Consulting Group here in Toronto, where I spent a couple of years before deciding that I really wanted to focus on the world of startups and be in a role where I would be able to do a lot more hands-on building. And so I ended up leaving and joining a fintech company in San Francisco called NerdWallet, where I spent a couple of years, and then moved back to Toronto and joined Wealthsimple about 4.5 years ago. And at Wealthsimple, I've worn a number of different hats in a bunch of different roles. But most recently, I've spent the last year on the crypto team, working on the crypto business. And that really is a coincidence, because I caught the crypto bug back in 2017, and it was something I was spending a lot of my personal time on, getting smarter about and learning and really trying to understand what was happening in the space. And when we decided at Wealthsimple that this was an area that we wanted to invest in more deeply, it became a natural transition for me to switch into doing that. And so over the last year, that's been my main focus. And in terms of career advice, I think there's two main things that I would give to the audience. I think one is really indulging your curiosity and keeping an open mind. The world is changing around us at an insane rate these days, and there's so much that's going to change about the world and about your specific fields and what you're studying and how your industries evolve, that being able to learn and change your mind and adapt is critical, I think, for anyone to be successful in any career. And I think starting now is important. And take crypto for example. This industry didn't even exist 10 years ago when I was in university, and now it's the thing I spend most of my time on. And so that really wouldn't be possible if I didn't keep an open mind about how the world is going to evolve and what role I'm going to play in it. So I think that is a critical characteristic of success. And then I think the second thing to really keep in mind is making sure you're not climbing the wrong hill. So what I mean by that is that it's very easy to have momentum behind the things you might already be doing. So if you're in a particular degree or in a particular job or in a particular industry, it's much easier to just stick it out and try to get that next promotion or climb the ladder in whatever context you might be in already. But you might realize you're just climbing the wrong hill, and I think that getting off that hill and finding the right one is much more it's going to be much more fulfilling in the long term, even though it's super painful in the short term. But I think being able to do that repeatedly is really critical in a world that's changing as quickly as ours is. And so those would be the two things that I would leave to the audience in terms of career advice.
Thank you, Dadish, for that excellent advice, and Rahana for all that great career advice, but also both of you for all of your wisdom and insights into how we can find the good side of money. Thank you all very much. Have a wonderful night.